point here, so I think let's get started. So everyone, welcome. Today we're going to be talking about how to use your venture fund forecast to manage investments. This is going to be a practical workshop where we'll be discussing how you can use fund modeling, not just for portfolio construction and fundraising, but also how to manage your fund after the raise. By way of introduction, I'm Anubhav, the founder and CEO of Tactyc, and I'm joined here today by Taylor Davidson of Foresight. I'll shoot it over to Taylor for introduction, but on my side, I just want to say if you haven't yet played with Tactyc or you're not aware of Tactyc, we are going to be showcasing that on this workshop today in certain sections. Tactyc is a forecasting and planning software for VCs to enable you to do portfolio construction, management, and forecasting all in the software without any spreadsheets. But with that, I'll kick it over to you, Taylor.
So, hi, I'm Taylor. I've worked with founders and investors in building forecasts and budgeting models for startups as well as venture funds. Done it for about 20 years, both part-time and full-time. And I have worked with funds building fund models specifically for probably the last 5 or 6 years. And I am really excited to do this with Tactyc today because I've used spreadsheets for doing these for probably 2 decades. And it's really great to see newer tools to allow us to do much more powerful things outside of spreadsheets. So one reason why I'm excited to kind of work with Tactyc and excited to do this today.
Awesome. So let's just go through a little bit on what we're going to be covering. Taylor, do you want to kick this off?
Sure. So the basic, the objective for today is we're going to go through kind of why even update your forecast model, maintain a kind of current portfolio model. When you're doing that, kind of what metrics are important to evaluate and track to use for decision making, and then we'll talk about how to do it, right? How to actually kind of maintain, build a current forecast model, run scenarios, and use it for actionable decision making around deployment of capital, but also around being able to communicate results to kind of your own internal team as well as limited partners. So that's kind of a general overview of what we'll do. Just as a general kind of idea, run a show. If you have, we'll take questions kind of throughout. Best place to leave questions is going to be in the Q&A. You can do general stuff in the chat, but Q&A kind of gets saved and logged for us to use. What I would say is, feel free to kind of log, just put in questions into the Q&A all throughout. We might answer them kind of during the first little bit, or we might hold them until later. But our goal today is to go through the initial kind of content here, and then leave plenty of time for kind of questions afterwards.
Yeah, and the one thing I will say is fund modeling is usually just a proxy for portfolio construction. This is not it. We assume you know what portfolio construction is. You may have built one already. You may have used Taylor's model, Tactyc, or however you might have done it. But we assume that is a known entity here. And today it's going to be, okay, what do we do beyond that? Because that's a frequent point of confusion. And it's also a very difficult problem sometimes to manage in terms of actually maintaining these models going forward. So Taylor and I talk at length about portfolio construction. It's frankly a hobby of ours. So if you'd like to talk about portfolio construction, feel free to ask us about it. We'd be certainly willing to talk about those as well. But the intention here is to move beyond that. Okay, so let's talk about why we should do this. Why should VCs even maintain a current portfolio forecast? Tell us about it, Taylor. How do you think about it?
So for me, the important thing is over time, the general way in which we build forecasts is we build a forecast model for a particular goal to create, hey, this is what we think the futures are going to hold. And then we sit on it. Then we start actually operating the business and we never kind of go back and review it. And that's not a great model in terms of being able, it's not a great process to be able to build models to use it for decision making. The whole thing about models is that allow you to kind of create a structure or a tool for analysis and kind of constant thinking. If you're not actually doing that process, then it makes it really hard. Now, it's also a hard thing to structurally do. It's a hard thing to continually update a forecast not based upon that. And we'll talk a little bit here about ways to streamline that approach in the theory as well as the practice around it. But there's a few things that we're trying to ways to actually use a continually updated forecast model. And the basic things we're trying to do is say, hey, how can we understand how how our plan is, how we're executing towards plan, and what should we change based upon that. So, a forecast model in our original portfolio construction approach represents our plan for what we think the future is going to hold, but, may not be the case. Like once we actually start executing, it's our chance to say, okay, what is the market? Is the market what I thought it was going to be? And that's when we start thinking about, okay, what we originally thought portfolio structure was going to be, we're actually seeing it in the market, right? Are we able to get portfolio allocations to do check sizes as we had thought? Our valuations, what we thought they're going to be, percentage ownership going to be the same? Or they have significant downstream impacts in terms of, what we have to reserve for follow-ons. Does it have a downstream impact in terms of what we'd expect in terms of kind of returns or structure from that? And so, as a big part of it, which comes like, hey, how are we? Is what we expected to be in the forecast, is that we're actually seeing in the marketplace? And one of the biggest ways to then and it's also important because just the same way that a regular operating company creates a budget and then creates a forecast and uses them to analyze the variances between them and understand and kind of constantly adapt, a concept of a portfolio model offers the same opportunity. But I will tease out the fact, like, some aspects to our areas that are more outside of our control are more reflective or more long-term, and some are more short-term. Like the long-term ones, like the downstream implications in terms of cash reserve is one, but like downstream in terms of like performance metrics, like, are we getting allocations in a way that makes sense? Do we think we can hit our performance metrics? Especially in funds, it takes a long time to come through. And so those are like a long-term kind of consideration for it. But short-term, being able to do it in terms of understanding kind of capital deployment, right? Are we actually able to deploy capital on the schedule we thought we were going to? Does our schedule for when we're going to kind of invest capital, does it still make sense given upon that? And so, there's a big part of that where we're able to use a constantly, updated forecast to track our performance, track our capital deployment schedule, see how we're kind of executing against that. You want to add a few things to that?
Yeah, I think that's great. The only thing I'll add to that is a VC fund life cycle. Let's say it's a 10-year life cycle. The investment period is 4 to 5 years, right? You're going to see at least one shift in the market environment during that investment period. So by definition, there is going to be a shift in terms of what you think valuations and round size are going to be during that investment period. That's at least one shift is going to occur. We're in the midst of one right now. And so your construction strategy is 100% not going to be true in terms of what that might look like for your actual fund deployment. And this maintaining a current forecast allows you or enables you to be nimble enough to change that strategy going forward. Now, the question is, what does that mean? What metrics are we tracking? How do we determine what is important to us? Because a lot of this is, are we tracking for the sake of tracking, or can we act on this data? So what are the key metrics that we should be looking at when it comes to tracking and then building a forecast on top of that? And that's going to be the next section here. So, all right, Taylor, do you want to just give a quick run through on this, on what metrics are important to us here?
Yeah, so think of it this way. So the important thing to understand is all metric tracking should be tied to the goals you want to use it for. And I say this because it's easy to create metrics. It's hard to actually use them for decision making. It's usually not useful to do tons of data tracking metrics around things you aren't going to use. So the most important thing about is what decisions you're going to make. Now, the metrics that are important to you to use in decision making will vary by lots of things. They'll vary by the stage you're investing at. They'll vary by your own investment strategy. May vary by the maturity of your fund. Like, so the metrics you may care, track, or be able to action upon may be very different between year 1 and year 4 or 10. So it's important to understand the context of what you're trying to accomplish around metric tracking. Now, the biggest, I think, difference between the different kinds of metrics comes down to performance metrics versus deployment metrics. Now, what I mean by that is, like, performance metrics are downstream impacts to the portfolio construction, like saying, hey, we thought we were going to get a certain allocation and ownership at a certain valuation. What are companies, are we seeing in the marketplace? What are valuations in terms of later rounds as well? Or are we still maintaining the same ownership percentage? Or are we getting diluted more or less than we kind of originally thought to? Now, that's something that we can control by our decisions a bit by saying yes or no, but it's still a little bit like we're still reflective of the market in many ways. The one we control a little more is around deployment. It's basically, hey, how many times are we saying yes or no to companies? And how much capital are we deploying across them? What does it look like across for new and follow investments? And so I think of like pacing as an important metric to understand, to use to say, hey, how am I going to adapt or modify my capital deployment schedules? Am I doing the right number of deals and check sizes that I'm expecting from there? And then the key thing is then you can, if you're doing that, then you can start thinking about, hey, do I think my deployment schedule made sense? Am I over investing or under investing? What do I need to do to change in my sourcing strategies? Am I getting the right types of deals that I thought I was going to do from the right stages or geography or types of founders or whatever it is? Do I need to change or structure that accordingly? And a lot of fund managers will do that using, detailed like CRMs, right? So CRMs understanding, hey, what kind of inbound deals are we getting and tracking performance metrics from there, or metrics around the companies we're getting in there to understand what our pipeline look like. And I used to do that when I worked in VC. But it also comes down to the point of, specific around the fund forecast model is how is that reflective or show up in terms of a deployment of capital and the impacts on the portfolio?
Yep. And I would just add to this that we have 4 different categories of metrics to track: pacing, check sizes, round sizes, and of course the company KPIs themselves, their portfolio company KPIs. What's controllable, what's not. The first 2 are somewhat controllable, the last 2 are not. And so that's the way GPs think about things. It's like, okay, what are my controllable variables? And then later on, they might go in and actually run scenarios based on those. And we'll talk about those as well. But the last 2 metrics, things that are not controllable, they are inputs into your model. They should not be parameters that you're changing in free will, because you can't really control the market. You can select which deals you're participating in, but round sizes valuations are coming to you, not going from you. So just think about it that way in terms of what you can control and what you can control. And then the reason we bring this up is the model that you build or use or buy should have the right inputs and outputs parameters. A lot of folks sometimes use a reserve ratio as an input. I want a 45% reserve ratio in my fund. That's great. But that may not always be in your control, because if you don't have enough companies graduating to the next point, you may not have a chance to deploy those reserves. And so think of things in terms of what exactly is a controllable. That should be a model input, and output should be let where the chips fall and let the model say what it does. So this is actually an area I might just take a very quick snapshot of Tactyc to kind of show what this looks like in terms of the different metrics that we're talking about. Are you guys able to see my screen? Okay, cool. So we talked about pacing, check sizes, round size, and company KPIs. For those not familiar, this is Tactyc. This is an active fund on Tactyc. This is a $150 million fund that's about, let's say, halfway or a third deployed through its life cycle. As you can tell, we are always summarizing actual versus projected. So reserve ratios, number of investments, fund returns. In fact, you can always flip back and forth between actual and projected. There's always 2 versions to your fund on Tactyc. There's a construction forecast, just meant to represent your original plan before you time travel back to when you think of what you sold to your LPs or what your plan was. And then the current forecast says, okay, you've done 21 deals. Here's where we think you're going. So the metrics that we're talking about tracking, pacing, we show a couple of ways of doing this. First of all, volume. By entry round, how many deals did we think we were going to do in each of these buckets? What have we actually done? Where do we think we're going? So what we're saying here is we were trying to do pre-seed investments initially when we launched the fund. We've done none so far. And we are projecting how many we might be able to get to towards the end of fund's life. We do this for each of these categories. Secondly, a time-based pacing analysis. So this is based on volume. How many initial deals I thought I was going to be doing by this point in time, and how many have I actually done? So how am I tracking on that initial pacing? And then follow-on pacing. Follow-on pacing may not be a controllable as well. This is governed by your portfolio companies when they are graduating to the next round. Clearly in this example fund, and this is an example fund, not a real fund, but in this example fund, we have a very high follow-on velocity, way higher than what we thought. So what this is indicating to us is our companies are graduated much faster than we expected. And that's a data point. That's something for you to think about, that, okay, I might be actually able to deploy my capital much sooner if this continues to happen. Now, that's a thesis you, the GP, needs to think about. If you think graduation terms are going to continue getting shorter, especially at the seed stage side, and that could be an input into your model that obviously affects IRR counts. So this is based on volume, and then this is based on dollars deployed. So then we do a pacing analysis to show you again, what was your original projection in terms of capital deployed? What have you actually done? And then what the current projection looks like. We'll talk a little bit later on how we come up with the current projection. I think that's a later point, but just table that for now. The second metric that we talked about was check sizes and reserves. So we have a chart in here where we show you construction versus actual comparison by the type of deals that you're doing. And there's about 6 different comparisons we do. Initial checks, what did you believe your averages were going to be? What have you actually done? Where have you gone off track? So in this fund, I was not planning on doing any Bs. I have actually done a couple of B rounds. I have clearly underinvested slightly in my seeds and Series A, but nothing meaningfully off. But when I look at reserves, I have reserved a little bit higher than I expected than my A's. In fact, A's I wasn't even planning on, and I ended up reserving some capital there. But this is showing you how you have responded to what the market is giving you, as opposed to what you thought it was going to be. And then it's the uncontrollables, valuations, round sizes. So how has the market evolved in terms of what did you believe it was going to be in terms of valuations and what it actually has been. And then we also show a cost of 1% equity, which is the cost of an ownership. What does it cost for you to buy 1% of that company? KPIs is a whole separate thing where you're tracking individual company KPIs. You can do that within Tactyc. You can do that in however you'd like to, but for every single company, at least in Tactyc, we try and show you projected versus actuals. So the idea is to pick a single investment and to say, okay, what were my projected or management projections or your own internal fund projections for things like ARRs or cash balances, and then to actually compare them with actual data as you get those, and then to see how they're comparing with that. All of this should, by the way, feed into your reserve planning as well. Obviously, if a company is far exceeding their KPIs, that's a great data point. That's something that should give you comfort on that company's future execution risk. So, yeah, that was just a very quick snapshot of some of the key metrics we try and summarize. And with that, let's try and move on to anything else you wanted to add to that, Taylor?
No, I think it was a great overview.
Okay, cool. Okay, cool. So then let's talk about how to build a current forecast and why that could be somewhat difficult. Taylor, you've done this a lot, obviously, in spreadsheets, which is, and for those not familiar, Taylor is probably the best in the world when it comes to doing this stuff in spreadsheets. So talk to us about it.
But not everybody likes spreadsheets, right? So like spreadsheets come with pros and cons. Spreadsheets are great as analysis tools. They're really hard to use as management tools. They say, like, one of the reasons I kind of tease this at the beginning, but building a model and constantly updating it using for decision making is really the goal of any model. The goal is the analysis, not the artifact of the model itself. Mm-hmm. However, we often don't do that. I've been doing spreadsheets for years, and I can't tell you how many times someone builds a model, doesn't look at it, and comes back a year later and says, "Hey, I need to update a model."
Yeah.
And we don't do it because it's hard, right? It's a hard thing to actually do, and especially at the level of detail when you're building into really detailed portfolio construction. To give an example for this particular purpose, it becomes really, really, really hard to do, and that's why we can do that in spreadsheets for for small portfolios or small deployment of capital. But when you start to get to larger deployment sizes and number of companies to manage, you spend a lot more time updating the model and doing the calculations rather than using the model to draw insights and make decisions from.
Absolutely. And what I've seen is there's a very big, and by the way, everything we're saying on this is coming from actual experience of working with managers. We should have probably said this at the top of the call. But what we've seen is this is possible to do in spreadsheets, but you need a team, because what ends up happening is it's a spreadsheet ecosystem. It's not just one model. You might have individual deal level forecasts, which eventually roll up to a fund level forecast. These might be individual spreadsheet files, and that's a lot of management. So that is not a one-person job. That requires a whole team. And that is just to be able to build a forecast. The next level after that is like scenario planning and actually running different versions of things, different versions of the world. Honestly, most funds don't even get around to that. The ones that do spend a lot of time doing that, but that's a hard problem to solve. So let's talk about the algorithm of like, how do you come up with, you've done the portfolio construction, how do you now update it for actuals? I'm going to split this up into two different things. The way we view it is you have active companies and you have undeployed capital. For active companies, what you want to do is actually build deal level forecasts. So for each of the companies, you might have an investment thesis that you underwrote to, eventual CAMs, eventual exits, eventual reserves deployed, what that exit multiple might look like. You want to build a model for each of those companies. And that is the expected performance of all of those companies. I want to show this to you in a bit as well. Then you have undeployed capital that is just sitting there that's remaining to be called. How should that capital perform? And the standard way we've seen this done is we assume that the remaining capital will perform at the original construction levels. So in construction, you said you might do 3x on a pre-seed company. Well, that's what we'll assume you'll do for your remaining capital. Combine the two together, and that's your current forecast. So basically, you have active investments that you forecasted where you have knowledge. Where you don't have knowledge, you're saying, I'm going to assume I'll do what I said I'm going to do in the plan. And that's what builds your overall current forecast. Anything to add there, Taylor?
Well, so, and the important thing from there is there's what you're doing is you're building this for two use cases. One is you're continually updating the forecast to create a continual, like we call like a rolling forecast, where you're combining both the actuals and the forecast. You're saying, hey, this may have been our original plan, but if we continue forward on the path that we based upon the periods we do know in our forecast for the future, this is what a new forecast would look like. So that's an important way to, or it's a valuable way to communicate expectations in terms of deployment performance. And the other thing you're doing from this is you are being able to look at, say, hey, here's what's actually happened versus what we thought was going to happen. And that's for like we use for like variance analysis. You know, the typical like company, any company is saying, hey, what we think we were going to do, what did we do? Kind of comparing the two. And so really it serves for those two purposes as like an internal tool to use around decision making and to understand performance, and then a forecast that we can use to also, you know, use to adjust our own expectations, but also communicate that to others as well.
Exactly. Yep. So let's show this in action. This is where we're going to get in the guts of things a little bit. So we're going to talk about two things. How do you build deal level forecast? And then how do you marry them together to build your overall current forecast?
And Anubhav, really quickly before you start, we do have a question from someone asking if you can use Tactyc to run scenarios on how future dilution can impact returns on individual investments. So maybe as you're going through the deal level, you can talk about that as well. Perfect.
Yeah, that's exactly what I was going to address. So in Tactyc, you can add your actual portfolio companies to build your real build forecast for individual deals. Now, for every company, I'm going to skip over a lot of portfolio management stuff. I mean, Tactyc does that. You can track a lot of things by sectors, by geographies, but I'm going to really focus on this section where you can build out the rounds of these investments. These are rounds that have occurred. So in this particular case, this is a company called Alpha Tech. We invested in the A round. We invested in a safe this amount and this valuation cap, and that's just data entry. So you're representing historicals. And Tactyc is, as you can tell, calculating the ownership and the fair market value at the end of each of those rounds. We also did a Series B. In fact, we actually ended up investing our follow-on in that B round. And as you can tell, we've already calculated your ownership and your fair market value. Now, Tactyc also enables you to build the forecast automatically. So it'll actually enable you to build out new rounds beyond the historical rounds you've done. For any of the new rounds, if you'd like to reserve a pro rata, it's as simple as saying I want to reserve my pro rata, and that automatically gets captured in that forecast. In fact, for any of the rounds, you can also set custom assumptions on what you might want valuations and round sizes to look like. Now, one detour here that I'll show is we also try and optimize your reserves during this deal forecasting process. The way we do this is we show you what is the optimal follow-on investment in this company, in this round for this company. And there's a couple of data points. Number one, how much do you need to invest to maintain your pro rata? So that's just most funds have a pro rata, right? What does that number look like? If you can actually do more than a pro rata, then this becomes even more interesting, because what we're trying to show you here is at different investment levels, how do these economics change to try and help you triangulate to the right point? What is happening is some of the metrics are moving in the right direction and some of them are moving in the wrong direction. So for example, ownerships, return on the funds, these are moving in the right direction. You want the return on the fund to go down. You want this to be a fund return maybe. And so as that metric moves down, that's a great sign. Having said that, your exit multiple, which is the expected multiple you'll get on this total deal, if you make that reserve, that will move down. This should not be a surprise to anyone, but the more follow-on reserves you have, the lower your TVPI is going to be, assuming it's not a down round. So your multiples are going to decrease, but your proceeds are going to increase. So what is the right point here? Well, that answer depends on you. So what is the right tipping point for you in terms of where you're comfortable with, underwriting to a certain ownership or a certain multiple, as well as in terms of total exit proceeds? The final metric we show here is a deal reserve ratio, which is, forget the fund, what is the amount that I'm reserving for this particular company, and what is the reserve ratio for just this deal? The reason we want to show that is opportunity cost. If you are far exceeding the reserve ratio here compared to your fund's reserve ratio, that effectively means you might be taking capital away from another company. If I have a 75% reserve ratio here for a particular deal, and my fund reserve ratio is only 50%, that means I've probably eaten into the capital from another deal.
And when you say deal reserve ratio, that percentage is a percentage of original investment check?
Percentage of total invested. So reserve divided by initial plus reserve.
Got it. Can I ask a question? So the valuation stuff is really interesting showing this. Where do you get the data to set the expectations for the returns?
Yes. So in the construction part, and this is a little bit detour, but in the construction, when you're first building a fund, we try and ask people to build a sector profile, a macro profile. What do you expect round sizes or valuations to look like for the rounds that your companies might experience in their life? This is where we give you data. So we give you pre-benchmark data. This is coming from Carta, Crunchbase, PitchBook in terms of median round sizes and valuations. We update this every quarter. Obviously, this is something that you might want to tailor this for your geography, for your sector, but that is the starting point for when you're building an actual investment. We assume it'll do what you said it'll do on average for that sector. And then you can come in and customize those over time.
Yeah, data is one of the hardest things to get in terms of doing that sort of thing. And so there's a combination of doing forecasts around this is where it's like reflective, like you're trying to use market data against it, but you're also trying to adapt it for your particular strategy. So combining, starting with a point of like, hey, here's market data you can start with, and you can modify it is really easy starting point. It's good to be able to use those expectations to be able to ground the ratios and other returns going forward. Because you mentioned this before earlier about like setting reserve percentage as an assumption, for example, and that's something that people often get wrong, right? Because what you assume you're going to get a ratio won't make sense based upon whatever graduation rates and valuations and things you're going to have. You could say, hey, I'm going to reserve a certain amount of capital, and then my strategy is to invest into one check size or two check sizes. And like, well, that doesn't work. Right. It's a very, very easy thing to get wrong. So having a good starting point for that kind of works well.
I see a question, which is why should the return on the fund go down? And this might be confusion on what return on the fund actually means. So return on the fund is the valuation a company needs to achieve for it to return your entire fund. Basically, what is, if I have a $500 million fund, what is the valuation of this company need to be for it to return my entire $500 million? A single company, it's called a fund returner. And so I want that number to be low because the more I own of the company, the higher likelihood that this company might just return my entire fund. So D-level forecast is basically you build out future rounds. You can also put probabilities, and Tactyc does this automatically, but you can put probabilities of graduation rates at these individual rounds as well. So again, we will default this for you based on those sector graduation rates. If you start to have higher conviction on a company actually going on to the next round, you're obviously welcome to change these graduation rates. But the key thing to note is that the FMVs and the exit proceeds and the multiples are all risk weighted. You're seeing a $500 million exit here, which is only a 2.5x return. And that might be confusing why that is. And that's because I have risk weights, these risk weighted methodologies happening in the middle. Another way, and this is a very common way to do deal forecasting, is to build scenarios. So you can actually have multiple versions of the world of what you think a company might perform at. Base case, a downside case, a home run case. And each of these cases can have different reserve levels, different exit scenarios. So you can build a completely new future for every company. And you can then put probabilities at the case level instead. This is a very standard weighted case analysis. And then we try and show you what that looks like on an expected returns basis. So what is the expected reserves, expected multiples, and expected proceeds you might choose to get from all of these.
So you're actually doing a risk-based thing at two levels, doing a risk-based at an individual, like, hey, what do I expect graduation rates and valuations to be at each round? And then creating risk-based estimates from that, but then also laying on top of what you think discrete different scenarios are, and then creating an average from that as well.
Exactly. And I will emphasize one thing here. There is a risk of falling into being overly precise about something that's inherently imprecise. And so at the end of the day, choose what approach works best for you. A lot of our clients like to just work at the case level, and they say, forget about the graduation rates down at the bottom. Other folks like to actually work with the graduation rates concept instead. So again, your mileage may vary, but just remember, this is something that is a constantly moving parameter, and you want to limit the number of parameters you're changing over time as well. All of that to say, yeah.
We have just a quick question on, or kind of a comment on the input data, if it's US based or global, and just sort of someone commenting on the ability to customize that regionally if you're an international fund.
We can. We build out custom profiles based on different sectors and geographies all the time. And in fact, any round can also be in a different currency. We do exchange rate conversions, all of that natively within the app. So yeah, just reach out to us on that.
I mean, and one thing I'll just say to this is that people often want to change expectations, right? So like there are general expectations in terms of performance of average investment, performance average company, but from a lot of data sources, it's best to use them as like directional indicators rather than absolute averages, because of the way that we construct data in the venture industry in general. And so even if you have general US data, even if you're a US fund, you'll probably still adjust them to reflect your particular stage or your particular thesis or your particular market. Like if you're a biotech fund or a fund investing in the Midwest, or how about you're a venture studio or an accelerator, you're going to have probably a different perception of what your market is, which may not be the same as the market. So not only would you want to change that for international, but even any US fund will want to review the baseline assumptions to modify. It's good to start, and it's good to have a good starting point, right? Starting from a good starting point and then being able to modify, it's a lot easier than having to create everything from scratch.
Exactly. And by the way, one of the things, just a side note on this, on international funds, what we've seen, seed, Series A, maybe pre-seed, these are all maybe very custom to your geography. Once companies reach beyond Series B onwards, they start to look and feel a lot like US benchmarks. I think they start to attract a lot of US capital too. So that's usually what we've seen in terms of how people lay out geographic profiles.
Good point.
Just to quickly wrap this up, you do D-level forecast for all of your companies. And again, all of that dovetails into your overall fund level forecast. So then we try and show you, okay, your TVPI or DPI, what was your original projection? What is your actual to date? And then what is your current projection look like? So that is what D-level forecasting looks like. And again, you're welcome to do this in whatever favorite tool of your choice. Just remember that you'd want to basically use it for your reserve planning, and you'd want to have some kind of probabilities built in there as well. Okay, so next section, I know we're
good. One question I have for you is, so you have this like cycle of like being able to modify all the data and basically continually change it when everything happens. And I'll add this as well, but like, what have you seen managers do in terms of the right cadence for doing this? Right? What's important to do on a what basis?
Glad you asked that. Yeah. So every quarter, this is a quarterly, usually most funds have internal portfolio reviews every quarter. That is usually the right point where you want to take a look at all your reserves, take a look at all your probabilities for each scenario, and take a look at your KPIs that you're getting from these companies. And that's the point you kind of update your overall fund model. This is not something you should be doing weekly, because that is just being a bit too reactive. It is something you want enough of a runway of data point for you to feed into that decision point. And so quarterly is our recommendation and how we usually see this being done.
Makes sense.
All right. So, and then I should say, like, you update this, but then how do you act on this data? So you've gotten all this data, you've updated your plan. Should you change your fund strat? Should you say, no, I'm going to, stick to the course. I'm going to continue. I'm going to wait for the market to do what I think it does. All of those things that don't need to happen every quarter. You should not be changing your fund strategy every quarter. That is more of a yearly process, or every 6 months. So, Every quarter you update data, but then every 6 months or so, you decide, okay, do I need to change my strategy for the next 6 months or for the next 2 years? Which brings us to how do you act on this data? So we've gotten all this analysis, and what are the key insights? What are the key actionable items we can work here? I'm going to split this up into deal level and fund level. So there's things you can do at the deal level in terms of reserve optimization beyond what I just showed you. And then there's things you can do at the fund level, which is running different scenarios. So with that said, at the deal level, you are 2 years into the fund's life, you've done 21 deals, and now your companies are starting to ask about reserves and follow-ons. Which company should you follow on into? It's the most common question. And there is no right or wrong answer to this. Obviously, this is very fund dependent, but we give you a framework on how to think about this. The problem is, let's say you have a SaaS investment, you have a space company investment, and a direct-to-consumer investment, all with different TAMs, different profiles, different probabilities, and eventually they're all, let's say, asking for the same next dollar from you. Follow-on reserves is an opportunity cost exercise. Where is the best investment for that next $1? Because you're taking that $1 not just from another company, you're taking it from a next net new investment as well. Here's the way we think about this. We rank all of your companies based on the expected performance of your planned reserves. So what is this number? This is a multiple. This is showing you the expected return on the next marginal dollar of the reserves that you've set for that company. You've built out scenarios for every deal. You've built out forecasts for every deal. What we can do is compute the step up from an average follow-on share price to your exit share price. That is what we call the follow-on multiple, and that's what this number here is. You then now have an apples to apples number that you can compare all of your space investments along with your direct-to-consumer investments. And that allows you to think of things in terms of opportunity cost. Where's the next best dollar spent? And then that is what we're trying to show you here in terms of how you might want to think about it. This is one of the ways, though. There's probably a lot of ways here. Anything to add there, Taylor?
No, I think it's great to be able to utilize it like this. I think the key thing about this one is like you can do the ability to like do scenarios on a deal by deal basis and then use that to kind of roll into like a fund level perspective is really, I think, one of the most valuable ways to continually update it. It's also hard, right? So like you traditionally do this in a spreadsheet form. It can be hard to do deal level analysis and to do this. It's easy to do at a certain level of data and a certain level of complexity. Say, hey, I'm investing $1. What do I expect my returns to be?
Yeah.
But to run that through the analysis of the individual cases and expectations for a company based upon different valuation and graduation rates, that's hard. It's hard to manage that level of complexity and do it kind of constantly updated to create a full fund level forecast.
And now we're going to take it up even another level. You've done scenarios at the deal level. Now let's do scenarios at the fund level. So what I'm seeing here is this is a fund that originally I was underwriting to a 4x TVPI, great fund. And based on all I've done, all this work I've done at the deal level, I've lost a little bit. I've lost about half a turn. And now I'm tracking to 3.6x. Now, this is, of course, just a guideline. This is not saying that you're actually going to get to 3.6x, but the point is that your actual deals are now expected to slightly underperform compared to what you thought they were going to be. How do I get back on track? Now, that's a very difficult question to answer, obviously, because there's multiple variables you can pull. It's a multivariate problem. One of the things we enable you to do is to build different scenarios on how you expect to use your remaining capital. So you could, for example, come in and say, I want to build a scenario where I change my model parameters which will govern how my future capital gets deployed. So you can revisit your assumptions on graduation rates, on exit rates. Have your actual companies graduated much better than you expected, worse than you expected? Well, now you have data points. It's no longer just a free variable. You can actually control that, and you can actually put in what you're seeing in the market and what your expectation of that might be. Similarly, allocations, the deals you were trying to invest before, based on what you've seen, on what your actual investment patterns have been, how might I change my check size amounts? How might I change my follow-on amounts going forward? And this will only apply to your future capital. And so out here, I've built a case where I've now increased the amount of follow-ons, the amount of allocation that I've put towards pre-seed. So I'm saying I'm going to be doing a lot more pre-seeds. And I've also changed a little bit of my follow-on strategy here. And we will then show you what this scenario looks like in terms of number of deals, expected returns, and we'll compare that with your current fund. and you can obviously save this. The point is you now have deal level scenarios, and you also have the ability to run fund level scenarios to control how that future capital might get deployed. And you can build obviously as many scenarios as you want. Anything to add there, Taylor?
No, I mean, my thing on scenarios is kind of come back to the beginning is that constantly updating building models is hard. It's a valuable thing to do. It's also hard, and especially this level of scenario stuff, it's hard. Building scenarios and data tables and all that stuff in spreadsheets, the bane of all spreadsheets. And so, being able to, and I'm not saying this because I'm trying to like hype up Tactyc, but I'm saying like doing scenarios is a fundamentally hard thing to do. And the better tools we have to be able to do that is just really great to see. And so,
yeah.
But it's kind of like, it's also the whole point of doing all of this, right? So like the whole point of building a spreadsheet and building a forecast is being able to use it to make decisions, and being able to use it to make decisions means we have to evaluate the future. But we don't want to just assume one future. We want to look at multiple different futures. That's what scenario analysis means at its core. And for anyone who's done this in any fund models, it's a lot easier to do this and build, 5 or 10 different spreadsheets that have different outputs,
different margins and data tables. Yeah, exactly. All right, why don't we talk a little bit about, so that is overall in terms of practical fund modeling tips and techniques. We'll talk a little bit about kind of workflows, and Taylor touched upon this already. So like, how should this impact your reporting, maybe your internal reporting, external reporting? We've seen some best practices here, which I'm happy to share, but Taylor, is there anything you'd want to add here in terms of how funds might want to think about structuring their internal workflow to enable this?
No, I think the points you gave earlier is right. I mean, you can review them around every deal or around any individual deal decision in terms of saying, hey, how's my allocation of capital compared to what I thought it was going to be? So you can constantly look at the deployment metrics on a deal by deal basis. But I wouldn't care about like an overall portfolio performance return stuff until like a more of a quarterly or annual basis. That's the key thing. The most important thing about it is you don't want to spend time doing tons of things you can't use to make decisions. And so, the degree to which being able to understand deployment is like valuable for each individual deal. And I think that's worthwhile. But you don't want to spend too much time in just kind of analysis, create too much time analysis and then actually taking actions upon it. So that's the most important thing. And it's very easy to spend, hours across multiple people in a team kind of constantly updating everything.
Yeah.
And I think that's valuable for some types of analysis. For a fund level strategy, annual process, that's a valuable thing to do. As an everyday, weekly, monthly thing, it's less valuable, especially because we're busy finding new deals.
Yeah, exactly. Your primary goal should not be updating fund models. It should be doing deals. The only thing I'll add to that is all of this should honestly be part of reporting, internal reporting and external reporting. So your LPs may not see all of this work. They might see just a very slight sliver of it. I mean, you might look to share with them certain things like, what does my performance by a sector look like? What does my performance by geography look like? Just like actuals. Obviously, typically GPs wouldn't want to share guidance on what they expect to be doing with the fund and be benchmarked to that. But the idea is your internal portfolio reviews should be talking about what your expectations are, how much reserves do you have deployed by geography, by sector, all of that stuff. You should be looking into that. And then a sliver of that should eventually go out to LPs. At the end of the day, the only thing I'll say to kind of tie things up is being data-driven is a choice. And it's a choice that I think your competition is doing. Everyone, LPs are asking GPs to be more data-driven in terms of how you're allocating reserves, how you're allocating capital. So not to plug Tactyc, but it doesn't matter how you do it, but just do it. Whether it's in a spreadsheet or it's the Google Sheets, the workflow is far more important than the tool you use. And hopefully a lot of things and techniques we've shared here today can help you along those paths. Obviously, reach out to Taylor or me if you have any questions here, but we'll try and take some few quick questions here to close things up. Does Tactyc have any online tutorials for this stuff? Yes, our documentation actually has videos on it. Also ping me directly. I'm happy to send you stuff and talk through things with you. We recommend a few KPIs per portfolio company, but does Tactyc allow for receiving, consolidating, and visualizing more standard financial templates from portfolio companies? We actually do. The KPI manager, actually, you can build out templates where you're collecting metrics from your companies. You can send those requests to the companies. They can update it. You can get those data back. Again, just reach out to me, and I'm happy to talk more about that. Is that documentation in the software? Yes, that's correct. What if I want to play around with Tactyc? Is there a trial? There is. Just go to tactic.io, click on the big blue get started link, and you can get started with a 15-day trial for free. And if you're an emerging manager, we've got a few discounts as well. So just reach out to us. Just closing things off here. Let's see what else. Anything else, guys, that we're missing? What tools do you recommend to receive, consolidate, and visualize standard financial templates from portfolio companies? I think this is the same person asking. I will just say, yeah, there are great tools out there in terms of portfolio management things. I mean, there's Visible, which I think does a great job in terms of just simplified portfolio collection. There's very higher price tools as well. The Standard Metrics, Cobalt. So there's a whole gamut of tools that will allow you to get data in. Fund modeling wise as well, Causal is a great company. Highly recommend you take a look at them too. I think they do great model building as well. But yeah, there's a lot of tools out there when it comes to sort of being more data driven.
But the question is also around like, hey, how do you track the performance of all the companies? And that's kind of a hard thing to do. What's interesting about it, so I'll speak to like my own experience with that. When I used to work as a VC, one of the major things I had to do was do that. And this is like 2012, 2011 era, 2015, whatever. So it's a little bit, it's still 7 or 8 years past that. None of these tools that we're talking about today even existed back then. I think Visible was just getting started then.
That's right.
And it was a hard process to do. So like one of the major things that I wanted to do was track the performance of all the companies we invested into. And so I actually did two things. I did one, I created a Google Doc for tracking and basically use as a CRM to track all the inbound interest and deals we were getting, and had a categorization system to categorize different deals and store data on valuations and those things, which we use for understanding portfolio. But then we also want to understand the performance of the companies we invested into. And I created a Google form, didn't work that well. The data collection process for portfolio companies can be hard sometimes, especially if the degree at which you kind of do it can depend upon what metrics you want to track for that company. Do they want to share the data with you? What's their process for sharing the data? Did you invest enough money to get data from them? And so it's one of these things that can be a difficult thing sometimes to actually kind of to action upon. So I would say there's less of a tools question to that, being able to track KPIs for companies, but it's really like a process question fundamentally. And tools, like the KPI manager and Tactyc is a great tool to do that. But I would say think about it from a process perspective first and foremost, and then you can think about the right tool for it.
I couldn't agree more. I think a lot of teams initially just having that process and the workflow is more important. The tool comes in later. You could start this on Google Sheets and spreadsheets first, and then if you start to see that's not working for you, then you can move on to other tools. Great. Well, I think that should address everything that we intended to cover. Hopefully that was helpful for everyone here. Taylor, thank you for the time and for your insights here. Please reach out to foresight.is as well. They've got some great templates, not just for venture funds, but for your startups as well. So you should please definitely take a look at them. And yeah, reach out to us at Tactyc as well if you would like a demo or if you have any questions. Thank you, everyone. Yeah, thank you. Take care. Bye.
Cheers.